Welcome to Hargreaves Lansdown's Meet the Manager. I'm Joseph Hill and today I'm joined by Stuart Edwards, co-manager of the Invesco Tactical Bond Fund, which features on our well shortlist of funds selected for their performance potential. So Stuart, with the Invesco Tactical Bond Fund, you've got lots of flexibility to invest in bonds of all types with few constraints placed on you. So how do you make the most of that opportunity set?
Yeah, so as you said, the Tactical Bond Fund is an unconstrained, flexible bond fund, which is a remit that gives investors the opportunity to invest through the economic cycle. So for us, as we manage the funds, we're looking at risks and opportunities in the context of our fundamental economic view of the world, valuations, and our risk appetite. And I'd say that effectively there's three components to consider. Firstly, the fund has access to a very large opportunity set. So the fixed income universe is really large. So the fund can employ interest rate strategies. It can invest in corporate credit, so that's investment grade, high yield. It can invest in emerging market bonds. And how we choose to allocate depends on, as I said, it depends on valuations. It depends on our risk appetite, given our macroeconomic view. The second component is the flexibility of the fund, and I think this is really, really important because for the last couple of years we've been in this very volatile macroeconomic environment. So we believe that it's a strong virtue and ability to be very flexible. So that's flexibility is in terms of our interest rate exposure, how we manage our so-called duration risk in the fund, dependent on valuations and our views on interest rates, on inflation and growth, etc. And then the final component is the fund, I would say, is downside aware. So that's not to say that you can't lose money, but we're very downside aware, which means in practice, when we're looking to take positions in corporate credit, for example, the hurdle for taking risk might be a little bit higher than it would be for a fund that by default is invested in corporate credit. And equally, the hurdle for reducing risk might be a little bit lower. But we have, as I said, a huge, broad range of opportunities to take advantage of.
And in arriving at your final portfolio, you combine analysis of top-down macroeconomic factors like direction of travel for economic growth, interest rates, inflation, with bottom-up individual bond analysis. So could you tell us more about how those two pieces come together to form the portfolio?
Yeah, sure. Look, I mean, the starting point is the top-down view of the world because ultimately that dictates our risk appetite. And depending on our risk appetite, that is when we look to take advantage of opportunities in the different areas that I mentioned, whether it's corporate credit, emerging markets, or whether we deploy certain interest rate strategies. And our approach is we have a team of in-house developed market strategists, economists, and also resources on the EM side as well. So we get together, we talk over the desk, we have more formal meetings where we really try and sort of nail down our view, a macroeconomic view as it relates to interest rates, inflation, growth, and as I said, what our risk appetite is, right? And then once we've done that, once we've established where we want to be investing, that's when the bottom-up analysis comes in, and we have a large team of corporate credit analysts, both on the high yield side and on the corporate side. They are in charge of, or they look at certain sectors. It could be autos, it could be real estate. So they have a sector view, whether it's good value or not in relation to other sectors. And then drilling down further, they will look at individual companies, at the fundamentals, the strength of the balance sheets, etc. And then that will help us sort of allocate to across the corporate bond space.
And picking up on interest rates specifically, one of those top-down factors you referenced, we've been on a bit of a journey there. We've gone from the ultra-low levels we've seen in recent years, and then the rapid rise. But it looks like they've peaked now, and the direction of travel is expected to continue downwards. So how has that changed the opportunity set for you?
I think as a fund manager, you're always a little bit reluctant to say interest rates and bond yields have peaked because, look, we've been through a very volatile period for the past 2 to 3 years. But there's no question that bond yields are a lot more attractive than they were 2 to 3 years ago. So if you look at the yield on the 30-year UK government bonds, the UK gilt, That's at the highest level, or at least it was recently, the highest level since 1998 at just over 5%. And that compares to a level that was closer to 1% in 2022 and 2023. So there's no question that overall bond yields are a lot more attractive than where they were. And even in the last 3 months, we've had a big sell-off in government bonds, not just in the UK but elsewhere. Sort of about 1% in the case of bond yields for the US and for the UK since mid-September. So the starting point coming into this year is that bond yields are looking once again a lot more attractive. So we've increased our duration exposure, which is our interest rate exposure to many of these markets, because we think there's value. What I will say is that, going back to a point I made earlier, the macro environment is still very volatile, where you've got this push and pull of inflation and growth pressures. So we still feel that it's very prudent to be nimble, to be flexible with our interest rate allocation, our duration allocation, as it were. So, if bond yields or if government bond markets rally significantly over coming months, then we'll look at valuations and we may well reduce our interest rate risk. I think that's the kind of environment that we've been in for the last 2 to 3 years, and that's the kind of environment that I think we will remain in, going forward, at least for the foreseeable future.
And reflecting on your career so far, what top investment tip have you picked up along the way that might have been useful to know at the start?
I'm always looking for investment tips because I think we're in the business where you're always learning. Because let's face it, the investment environment, the macro environment is constantly evolving and changing. Look, I don't know if going back right to the start of my investment career, but I think one thing I have learned, and I wish I knew sort of 10 to 15 years ago, or rather had a greater appreciation of, is just the growth in populism. Because it's one thing that investors generally have got wrong. And I'm thinking Brexit, I'm thinking the election of Trump back in 2016 and more recently. I think as investors we're a bit guilty of looking at the world through a certain lens, and that is definitely a lesson. And the other, so Brexit was the first thing, and also the Eurozone crisis. So I think we've all learnt those lessons. We have to eat a little bit of humble pie and just sort of think, well, okay, we may think this is rational, but actually that doesn't mean to say that that's the way the world is going. So I think that sort of growth in populism is something that I wish I'd sort of a greater appreciation of, and the impact that.
Who would you say has had the biggest influence on you as an investor?
Look, I have to say is probably the two guys that recruited me almost 20 years ago. They were the two heads of the fixed income desk at Invesco in Henley. And I think I can speak on behalf of all my colleagues. We learnt a lot from them. That's Paul Reed and Paul Causer. They're now enjoying a retirement, but I think it's that ability and that capacity to take risk when the opportunity presents itself. And there's one thing that I do say to clients, that we're in the business. It's not just of trying to predict the future, but it's how you respond to events. Stuff happens. Anyone who claims perfect foresight is just nonsense. It's this business is about how you respond, how you take risk to the changing environment, and I'd say that they were very good at that, and they've imparted that philosophy on not just myself, but the wider fixed income team.
And outside of work, how do you switch off?
I enjoy running. I did the London Marathon last year. I enjoy trail running. I think I'm just trying to keep fit and reverse the clock and all of those things. But actually, I like being outdoors in the open environment. I enjoy the mountains. I do go skiing, and for me, that's a great way to sort of cleanse the mind and switch off.
Running's good. Stuart, thank you very much for joining us.